A brown envelope with the DWP crest on it. No logo you recognize, no company name, just the department and a reference number. Inside, a letter asking you to do something by a specific date, and if you miss it, your payment changes. Not a scam text asking for your bank details. Not a call from someone claiming your national insurance number has been suspended, because that particular threat isn't real and never has been. This is the genuine department, and the deadline printed on the page is genuine too. Here's what I want to walk you through today, because I've sat with enough pensioners who've had exactly this letter land on the kitchen table. There isn't one single 28-day rule that covers every DWP letter. There are several different processes, each attached to a different benefit, and several of them do carry a real response window, sometimes 28 days, sometimes a calendar month, sometimes something else entirely. Miss the window on the wrong one and money that was already coming. Not because you did anything wrong, because nobody ever told you which letters actually matter and which ones are routine. I'm going to go through the ones I see most often, tell you honestly what happens if you miss them, and tell you honestly what happens if you don't. Because in a good number of cases, the picture is less frightening than the headline makes it sound, and knowing that matters just as much as knowing the deadline itself. What makes this year different isn't that DWP suddenly invented deadlines. It's that several separate processes are running at the same time, landing on the same households within months of each other. A disability reassessment here, a pension credit review there, a decision letter about something else entirely arriving the same week. Any one of them on its own is manageable. Together, in a life that's already busy with hospital appointments, grandchildren, or simply the ordinary business of getting through a winter, it's easy for one envelope to get set aside with the intention of dealing with it later, and later to arrive a fortnight after the date printed on the page. Quick note before we go on, this is general information to help you understand the rules, not personal financial, tax, or legal advice. Everyone's situation is different, so for anything that affects your own money, check the official guidance or speak to a regulated advisor. There are free services for this and I'll point you to them. If this is useful so far, a like really helps the channel reach more people who need it. And let me know in the comments where you're watching from. I read them all. Right, the one generating the most letters this year is the move from Disability Living Allowance to Personal Independence Payment. If you're still on DLA, most likely because you were already receiving it before PIP existed and were never asked to move across, the department has been slowly reissuing invitations to make a fresh PIP claim. Around 150,000 adults in England and Wales are still on DLA, and the DWP is restarting this transfer in stages, with a small group of a few thousand claimants going through it first before any wider rollout. When your invitation arrives, you generally have 28 days from the date on the letter to start your PIP application. Your existing DLA doesn't stop the moment that window closes. It's designed to keep running while your PIP claim is being assessed, provided you started that claim within the 28 days, and government guidance says it will continue for at least 28 days after DWP makes its PIP decision, so there's a bridge built into the system. What actually puts the award at risk isn't a late assessment. It's not responding to the invitation at all. The honest catch here is scale. For someone receiving the highest combination of care and mobility support, that's £114.60 a week for the top care rate, plus £80 for the higher mobility rate, £194.60 a week. Over £10,000 a year, depending purely on whether the form goes in on time. That's real money for a household that has likely built its budget around it for years, sometimes decades. If your award is indefinite, it's easy to assume nothing will ever change, and for a long time that was true. It stops being true the moment this specific letter lands. Take someone like Malcolm, 71, in Cardiff, who's held a DLA award since his 60s for a long-standing mobility condition. It's never been reviewed, never questioned, and he genuinely believed the word indefinite meant exactly that. When his invitation to claim PIP arrived, his first instinct was to put it in the drawer with the utility bills, assuming it was a routine reminder like the ones the energy company sends. It isn't. The clock on that letter starts the day it's dated, not the day he gets round to opening it, and the form itself asks for considerably more detail about day-to-day needs than the old DLA application ever did, which is exactly why starting early matters. Nobody loses their DLA the moment the 28 days pass. What they risk is drifting past the point where the department can treat the claim as continuous, which is what protects the payment while the new assessment is carried out. The second one that catches people involves Attendance Allowance, which is the equivalent support for those who reach state pension age with a health condition rather than claiming under the working age system. Two things sit inside this one, and they're worth separating because they work differently. The first is the 28-day rule around hospital stays and care homes. If a council contributes to or fully funds your place in a care home, attendance allowance is normally stopped after 28 days there. If you're admitted to hospital, similar rules can affect payment depending on how long the stay runs and what else you receive alongside it. The department expects to be told, and the responsibility for telling them sits with you or whoever manages your affairs, not with the hospital or the care home. The honest catch on this one is that it only bites in specific circumstances. If you're funding your own care privately, without council contribution, attendance allowance generally keeps being paid. A short hospital stay of a few days doesn't trigger anything. What causes the actual damage is silence over a longer stay, where nobody thought to ring and say so, and weeks later a letter arrives asking why payments look wrong. Attendance allowance itself is currently £76.70 a week at the lower rate and £114.60 at the higher rate, tax-free, and it doesn't reduce your state pension or your pension credit. If anything, it can increase what you're entitled to elsewhere, which is exactly why letting it lapse through an unreported hospital stay is such an expensive silence to sit in. Think of Joan, 78, who moved into a care home in the spring after a fall, with the local council contributing towards her fees. Her daughter assumed attendance allowance would simply continue alongside everything else, because nobody had ever explained that council-funded care and self-funded care are treated completely differently for this particular benefit. 28 days after she moved in, the payment stopped, and it came as a genuine shock on top of an already difficult few months. Had the family known to expect it, they could have planned around the gap rather than discovering it through a bank statement. The rule itself isn't unfair, and it isn't hidden. It's simply one that nobody tends to hear about until it's already happened to them. The third is pension credit, and this is the one I think of as the genuine pension uplift, because for a huge number of low-income pensioners, it's the difference between just getting by and actually managing. The standard minimum guarantee for 2026/27 is £238 a week for a single person and £363.25 for a couple, and pension credit tops your income up to that level if it currently sits below it. From time to time, the department reviews an existing award, particularly where there's a reason to check that savings or circumstances haven't moved, and that review typically comes with a form or a phone call and a date by which you need to respond. Here's the honest catch on this one, and it's an important one. Not everyone with pension credit gets reviewed, and plenty of awards run for years without a single letter. When a review does arrive, it usually isn't asking you to prove anything dramatic, just to confirm the figures already on file are still accurate. The risk isn't the review itself, it's ignoring the form, because an unanswered review can lead to payment being paused while the department waits to hear from you, and pension credit doesn't just carry its own weekly amount, it opens the door to other help many pensioners never realize they're entitled to once that award is in place. Consider someone in a position like Stuart's. He's 74, lives alone in Preston, and has claimed pension credit quietly for 6 years without ever hearing from the department beyond the annual uprating notice. Then a letter arrives asking him to confirm he still holds the same amount in savings because he became a named signatory on a community fund account for his sheltered housing block, a minor administrative role with no personal benefit to him at all, but one that shows up as a change worth checking. He nearly ignored it, assuming it was a mistake that would sort itself out. It wouldn't have. A short phone call explaining the situation was all that was needed, and his award continued exactly as before, but only because he made that call rather than waiting to see what happened. If you're finding this helpful, subscribe and turn on the bell so you don't miss the next one. I cover this stuff in plain English, so you don't have to wade through 40 pages of gov.uk yourself. The fourth one is different in character, because it isn't about a routine review, it's about what happens when the department has already made a decision you think is wrong. If DWP reduces, suspends, or refuses a benefit, and you disagree, you generally have 1 calendar month from the date of the decision to ask for what's called a mandatory reconsideration, which is the formal request for them to look at it again before you're able to appeal to a tribunal. Miss that month and the original decision can simply stand, appeal route and all, unless you have a good reason for the delay that the department accepts. The honest catch here is that the 1-month window isn't always as rigid as it sounds on first read. If you contact them and explain why you're late, illness, hospital, simply never having seen the letter because it went to an old address, extensions are sometimes granted, occasionally stretching considerably further than a month in genuinely difficult circumstances. That's not a reason to leave it. It's a reason to ring the moment you realize you've missed it, rather than assuming the door has already closed. Now, the myth that sits underneath all 4 of these, and it's worth naming directly because it's exactly what real scams rely on. Some pensioners have started treating every letter with a deadline as suspicious because so much genuine scam messaging mimics official urgency. Text messages claiming your national insurance number will be cancelled. Calls claiming your bank account is about to be frozen unless you act within hours. Those threats are fabricated. Nothing in the genuine system works that way, and DWP will never ask you to make a payment, buy vouchers, or hand over your bank card to keep a benefit running. But the reverse mistake is just as costly. Assuming every deadline is therefore fake and letting a genuine one sit unopened on the side is how a real award actually does lapse. The difference between the two is simple to check, even if it doesn't feel simple in the moment. A genuine DWP letter references your existing claim, quotes a national insurance number or claim reference you recognize, and asks you to respond through channels you already know, your online account, a form, or a phone number that matches the one printed on your original award letter, not one texted to you separately. It never asks for payment. It never asks for your full bank card details over the phone. If anything about the request feels like it's asking for money or banking access rather than information, that's the one to stop and question, and Action Fraud is the right place to report it. There's a second, quieter version of this same confusion that catches people from the opposite direction. Some genuine letters are written in language that sounds more alarming than it needs to be, simply because government correspondence tends to favor formal wording over plain English. A line like "failure to respond may result in your award being suspended" is standard departmental phrasing, not a threat aimed specifically at you, and it appears on thousands of routine letters every week. It's worth reading past the formality to what's actually being asked. In almost every case, it's a specific document, a specific form, or a specific phone call, not a vague demand. If you're ever unsure whether wording like that is describing a real process or dressing up something invented, that's exactly the kind of question Citizens Advice can answer over the phone in a few minutes, and there's no shame at all in ringing simply to check before you do anything else. So here's what's actually worth doing this week, and none of it requires anything more dramatic than opening your post. If you're still receiving Disability Living Allowance and a PIP reinvitation arrives, treat the 28 days as the date that matters and start the claim rather than assuming your indefinite award protects you indefinitely. If you're on attendance allowance and you or a family member is likely to be admitted to hospital or move into a care home, ring the office that pays your benefit as soon as that happens, quoting the number on your award letter, and do it again when the stay ends. If a pension credit review letter arrives, respond by the date given, even if all you can manage that week is a phone call to say you need more time. And if any DWP decision has just gone against you and you think it's wrong, put the date it arrived somewhere you won't lose it, because the month starts ticking from there, not from whenever you get round to reading it properly. For any of these, PensionWise offers free guidance on pension-related decisions and is government-funded, and Citizens Advice can help with the wider benefits picture, including help actually filling in review forms if the wording is confusing, which it often is. Neither service will charge you, and neither will ever contact you first out of the blue asking for personal details, which is itself a useful thing to remember the next time something claiming to be official lands in your inbox instead of your post. It also helps simply to build a habit around post from the department, the same way you might already do with anything from HMRC. Keep a single folder or drawer for it. Note the date on the envelope, as well as the date in the letter itself, since the two aren't always the same, and it's the date on the letter that usually starts the clock. If you help an elderly parent or neighbor with their affairs, it's worth asking them directly whether anything official has arrived recently, rather than assuming they'd have mentioned it, because a letter that looks routine at a glance is often set aside without a second thought until someone else asks the right question. None of these four processes are new inventions designed to catch people out. They're the ordinary mechanics of a benefits system that occasionally needs to check its own records are still accurate, wrapped around real money that matters to real households. What's changed isn't the existence of deadlines. It's how many of these letters are going out at once this year, as different reviews and rollouts land in the same 12 months, and how easy it is for one of them to arrive at a moment when life is already full of other things. If one thing is worth taking from this, it's this. The deadline on a genuine DWP letter is not a trick, and it is not a threat. It is simply the date by which the department needs to hear from you to keep doing what it's already doing, which is paying you what you're entitled to. Open the letter. Check who it's actually from against the number on your existing award, not a number the letter gives you to call. And if in doubt, ring PensionWise or Citizens Advice before you do anything else, because working out which of these four situations you're actually in takes 5 minutes on the phone with someone who does this every day, and it's free. I'm sharing what I've seen sitting across the table from pensioners going through exactly this, not giving you advice on your own specific claim, because I'm not a regulated advisor, and every situation is genuinely different. For anything that touches your own benefits or pension, PensionWise and Citizens Advice are free, government-funded, and built precisely for this. Thanks for watching to the end. If you found this helpful, share it with someone in the family who'd benefit. These rules matter most to the people who never hear about them. And do check the official links in the description before you act on anything. See you in the next one.